Okay, everybody, it's me, Gregory Mannarino. This is my newest segment of Markets A Look Ahead, and I have a lot of stuff to cover with you. I'm just sitting here this morning writing stuff down. Right off the bat, happy Mother's Day to all of you lovely lionesses, my favorites of them all. All right, look, let's talk. Let's step back again. Let's take in for a moment what's going on here with this market. With regard to the 10-year yield, people you know and I know, the debt market is the key, as a matter of fact, to the market. Period, the end. There really is nothing else. It's the main driver here. And all the other nonsense connected to it is just that nonsense. If we keep our eye on the drivers of the market, well, we're going to be A-OK here. The reason why I'm bringing that up is if you were to listen to the commentary out here, I'm not talking about it on YouTube. I'm talking about the mainstream commentary. It's kind of interesting. You got half the people out here saying that this market is going to drop another 8 to 10% before we turn around. You got a whole nother group of people saying the polar opposite. Look, I understand that there is a lot of concern about what this market's going to do in the shorter term. We got a series of warnings, which you're going to cover in just a moment here. But look, for me and you, it's simple. We're going to focus on the debt market, which is the driver. The 10-year yield, more specifically, the benchmark. Keep this in mind, people. I know everyone is freaking out looking at what's happening here with regard to action in the debt market and the 10-year yield. In real terms, I want you to ponder what I'm about to say for a moment. In real terms, based against inflation, their own numbers, let's use their own numbers, 8.5%. We are massively and deeply negative with regard to real rates. It's insane. And this mechanism, as you know, as I have told you for, I don't know, for months now, it's massively inflationary. This is how we know for a fact the Fed has no intention of doing anything right now about inflation. You cannot keep the benchmark rate lower than the actual rate of inflation, which is way above their numbers, and expect this to tame inflation in any way, shape, or form. All it's going to do is create more inflation, and it's deliberate. It is deliberate. Does that make sense to you, what I just said? It really, really should. So anyway, looking back on the drivers here of the market, or the driver, okay, that is the 10-year yield, the debt market as a whole, but you and I focus on that 10-year yield. Right now, we are at 3.14, 3.12, somewhere along those lines. You and I also realize we're going higher. We're going to about 3.25 in the short run. So I know everyone's freaking out about what the 10-year yield is doing, but you and I have anticipated this already. Again, let's put this into perspective. You and I realized we were going to settle above 2 based upon what the Fed was doing at the time. We did that. We settled above 2 nicely. Then all of a sudden, the Fed's like, oh yeah, well, we're going to be really aggressive moving forward. What did the market do? It starts adjusting. It starts pricing that in. So we've been watching that 10-year yield rise now. Like I said, we're going to 3.25 in the short run. Now, depending on what else happens here, we will reevaluate. But in my view, there is no doubt, I want you to be ready for it, 3.25 is where we're going to go in the short run. Okay. So with that said, how is that going to play out to the rest of the market? In the short run, we could continue to see some volatility. We've been getting some pretty wild swings. I mean, let's just look at last week. It was epic. 1,000 points higher in the Dow, 1,000 points lower in the Dow, 500 points up intraday, down 500 points. We settled the week basically at the flat line, down 0.2% with regard to the S&P 500. So again, I believe if you follow this blog, things are progressing exactly like we expected it to do. Now, as you all know, again, look, I am well aware, and so are you, that at one point all of this is going to get very real. And by very real, I mean everything's going to reprice. A massive, if you want to put it this way, deleveraging event is going to occur in the stock market. It's going to be mind blowing. So let's put that into perspective. We understand the debt is in a bubble. It's not going to stop. We have central banks around the world, including the Fed, deliberately creating inflation to keep the mechanism of the debt-based economic model going. They want to utilize wars. They want to use disease processes, whatever they got to do to continue to pull cash from the future. That's all this is. Nothing you're seeing is by accident. Okay, so with that said, understanding that the debt market is the key. The debt market is a hyper bubble, and I mean beyond. It's beyond a hyper bubble, and they are attempting to keep that bubble inflated via any means that they possibly can. If you have my book, A Politics of Money, I outlined this a long time ago, that they will attempt to keep bubbles inflated by any means at all. But at one point, it doesn't work. And in my view, when that event occurs, it's always going to be, and it is going to be, a deliberate event as well. It's going to manifest itself because central banks are going to coordinate this, and we are going to see a massive amount of cash bleeding out of the debt market, a massive deleveraging event in the stock market, meaning it's going to crater. How do I say that another way? I've been telling everyone. I mean, I believe sincerely it is well within the realm of possibility that the S&P 500 could fall 80%. 80 from where it is now. Okay, so what is that going to mean? We're going to, again, you know this already. A financial event is going to sweep the globe that is going to change everything. And that's really what is being set up right now, honestly. A lot of things are going to come out of this here. This is why you need to be understanding why you are holding things like hard assets, physical gold, physical silver, my favorite asset of all time. And for the meantime, people, it's so simple what we're doing. We're taking advantage of the current environment here. Oil and gas producers, I think that's where you need to be. I've been explaining this. I also explained on Friday what I did. I consolidated a few positions here. I pulled profits out of ExxonMobil. I pulled profits out of CVX. I put this all of it into Devon, DVN. Doesn't mean you have to do it. I think these other companies, these other oil and gas producers are a good spot to be in here. You want to be long commodities via an ETF, PDBC. You want to be long crude oil as well. There's several ETFs for that, exchange traded funds. Look, we got this. And in the meantime, until that debt market melts down, I will be looking for opportunities to get long equities, certain stocks. My latest several are right on my website for everyone to see. TradersChoice.net. There is a link in the description of this video. You're going to find it right under the lovely chat room. Okay. So that's where we stand here in the market, anticipating that this 10-year yield is going to rise. It's going to rise. I mean, there's no doubt about it. In my view, could I be wrong? Sure. I doubt it. Okay, we're going to get to 3.25 soon. Probably next couple of weeks, something along those lines. And we're going to listen to what comes out of the mouth of public enemy number one. That is the Federal Reserve, who's deliberately keeping, in real terms, rates negative, assuring that inflation will continue to get worse. And it's astonishing to me, seriously. When was the last time you heard a mainstream propaganda ministry, pick one, explain to people again that they know this, in real terms rates are negative, and via what the Federal Reserve is doing right now by nudging that federal funds rate, keeping in real terms rates negative, there's no way it's going to stop inflation. No way. And with regard to the Federal Reserve balance sheet runoff, who's buying the debt? Who's going to buy it? They're not, it's not going to happen. They're going to have to hold their current assets until maturity, or debt assets, if you want to put it that way, the current debt until maturity, because anyone could go out on the open market and buy debt, if you want to, that's yielding higher than what the Fed is holding. I mean, look, they're not going to tell you any of this stuff It's distractions, deceptions, propaganda, lies, and I think you're all well aware of that. All right, look. So what I want to do here, people, I want to cover a few things. Like, look, I'm just jotting, I'm just writing this stuff down as I'm drinking my coffee this morning. Stuff I think is important. So we got another warning. We got several warnings. Okay, so I'm just going to read off some names. Bank of America is warning. Maersk, which is the largest shipper in the world, is warning. Moody's Analytics is warning. So what are they warning about? So Bank of America is, again, I mean, this is like 10 times over the past, I don't know, several years, and they've been wrong, except for the last few months about this market dropping. Okay, look, anybody out here who's saying that this market's going to crater, they're going to be right at one point. You and me, we've been on the right side of this for years, staying long. While everyone else is telling us to get short. While everyone is telling us that this market's going to crash, it hasn't done it yet. And what we're seeing now is not a crash. I've covered this a million times so far. Does it mean we're going to crash? Not going to crash tomorrow or the next day, but we have clues. We know where to look, okay? We're watching the debt market. We're watching the relative strength of the dollar. We're watching crude oil. The drivers, you all know that. So anyway, with Bank of America, yes, another warning. With regard to the stock market, okay, whatever. I've learned to ignore most of these things. With regard to Maersk here, they're saying that the global economy is slowing. How about, can I get you a duh? We already know that. It has been admitted that our economy here in the United States is shrinking. This is a global phenomenon. You already know that as well, so no secret. Now, with regard to Moody's Analytics, this is pretty interesting. So 97% of real estate in cities around the United States are overvalued, according to Moody's Analytics. Look, we all understand the mechanism. Suppressed rates here have inflated multiple bubbles. I don't think it's any secret here that everything is inflating, and it's by design. Federal Reserve melting down the dollar in real terms, okay? With regard to its relative strength or comparative strength, yes, the dollar has been the prettiest belle at the ball. And this is also a phenomenon you knew would occur from a very long time ago, years, where I always said the dollar is going to remain the prettiest belle at the ball. So I think that is no surprise. We keep hearing warning after warning after warning about recession, severe recession coming. In my view, it would be a step up from where we are now. Our economy is in collapse. And this is, again, a global phenomenon. You keep getting the finger pointing here. It's the war that's causing inflation. It's supply chain disruptions because of the war or COVID. But again, look how it's being deflected away from the Fed. It's not the Fed. It's not central banks around the world that have been doing nothing but inflate and inflate and inflate since the last meltdown with no end in sight, making sure rates stay negative, okay, in real terms, so they can continue to inflate right in everybody's face, while the propaganda ministry deflects you and tells you, oh, no, it's the war. Oh, no, it's COVID. It's this, it's that. No, they won't point their fingers at the freaking root cause here, which is central banks, none more so than the Federal Reserve. But you're well aware that you're too smart to fall for the dog shit. The fact of the matter is, look, anyone that doesn't understand that it's this organization here that is causing everything we're seeing, and I mean everything we're seeing. Nothing is by accident. Wars, disease processes, whatever it might be. This is all a mechanism here to bring the world to its knees, to their overlords here, which are central banks. Period. The end. Look, like I've been telling you for the longest time, the well-off and the rich couldn't be doing better. Middle class is getting extinct. They're becoming extinct. And this mechanism is completely, I think, predictable. You and I realize this from a long time. I've been telling people that we're going back to a two-tier society for like 10 years. And here we are. It's in our face. So look, like I said, people, what are we going to do about it? What are you and I going to do about all this looking ahead if we understand the mechanism behind it? We're not going to stop what we're doing. Betting against the debt, becoming your own central bank. I sincerely still believe that you need some crypto in your portfolio. I'm not saying to anyone they should be going all in on anything. You got to be diversified. You got to be spread out. You also have to realize that your overall portfolio is not going to perform perfectly 100% of the time. You're going to have certain assets that are doing well, other assets that are not doing so well. This kind of mechanism, that's how it works. And being diversified, being in things like, let's say, large cap dividend paying stocks, a whole bunch of different ones, let's say oil and gas producers, banks, consumer staples, some tech as well, understanding that it's not that nothing is all going to go up at the same time here. Something's going to underperform. That's the way it is. With regard to other assets, gold and silver, people, there's not a more rigged aspect of this market in my view. That's really the truth. With regard to other commodities, you got to hold them. I think you need some, and do your own research on this, okay? With regard to commodities, you can take advantage of this, buy an exchange traded fund. I had one posted for a while. I still own it, PDBC. You want to own crude oil, USO, UCO, there's other ones, look them up, and then do your own research into which one is right for you. It's not that hard, okay? Anyway, I think you understand what's going on. And with regard to cryptocurrencies, in my view, yet again, I'm going to tell you, I think the market cap is going to balloon once the debt market implodes. That's the only reason why I hold cryptos, okay? I'm not a trader of them. I don't use them to transact or anything along those lines. I believe, and I've been telling you this for years, I have not wavered, that I believe sincerely we're going to see a meltdown in that debt market, and cash is going to bleed out of the debt market, bleed out of the stock market, and when it deleverages, okay, or melts down, however you want to put that, and it's going to move. It's going to move into commodities in a big way because these are real things, and I think it's going to also move into cryptos, whose market cap is going to 2, 3, 4 times. Who knows? I mean, no one really knows. But that's my take on it. And of course, you're all entitled to your own opinion on it, on all of this. And I want to hear from you. So please do comment how you see this eventually playing out, what you have heard here in this video blog. Does it make sense to you? Let me know about that. And pretty much that's it, people. I don't know what else to tell you. I think we got it. I think we understand what's going on. We know what to do about it. We know why we're doing what we are doing. Pretty simple, pretty straightforward. All right, kind of a long video. Please, again, comment. Please share this video. Get it out there. And I will see all of you in the morning. Looking forward to it. Again, happy Mother's Day. Have a great day. I'm out of here.